Good morning, everyone. Just sitting here laughing at this stupid ass market and thought I would share some of the fun and frivolity with you. Here, for example, is a look at the NASDAQ 100, one of the main indexes. It's up nearly 350 points or 2.5%. But if I look at this list of stocks up, stocks down, I'll notice that I've got 20 stocks that are up by 1% or more. I've got 40 stocks that are down by 1% or more, and I've got another 20 stocks that are treading water. Well, I've got twice the number of downs that I have ups, but yet the index is up 344 points. That just shows you how influential one or two stocks can be to this entire index. It is not reflective of movement in the market as a whole. You know, this week we've seen the Dow and S&P 500 have several down days. Yesterday was, a good day for the market. Today's looking like it'll be a good day for the market. But earlier in the week, everybody was so concerned about the debt ceiling. Now, nothing, not a word. Everybody's focused on one company, Nvidia, and its earnings. So everything's obviously all well within the world. Reality, the world hasn't changed. The Fed released its minutes, and for those who were paying attention, several of the governors were talking about the need for further rate hikes. The futures market went a little crazy. The interest rate futures market went a little crazy because it had basically assumed almost a 0% probability of future rate hikes. Everybody was thinking this was the peak. Well, enter in the opinion of the Fed governors. Things change. We see here, looking at this index, the world interest rate probability. This is the U.S. Focus on the U.S. probability. And you'll notice at the June meeting, the probability has now gone to roughly 53% that there will be a rate hike. The July increases it to about 93% that there will be a rate hike. So now the market all of a sudden is almost again telling us that continued rate hikes are likely. Now, this projection shows, cuts beginning soon, August, September, whatever probability decreasing of other rate hikes. I'm not so certain. As we've talked before, inflation is pretty sticky. The super core that Jay Powell follows has not been moving, even increased a little bit. So I don't think the Fed's going to start cutting anytime soon. I think realistically, we probably see interest rates get to 6.5, and then stay there 6 months or 9 months before cuts begin. So we've still got a ways to go. Historically, inflation takes 2 to 5 years to tame, to get below the 2% target value. And Jay Powell has said repeatedly he's not going to repeat earlier mistakes of Federal Reserve governors when they started cutting too quick. Now, what will the political pressure be on Jay Powell? It's obviously huge. So you've got to take that with a grain of salt. But do feel relatively convinced that Jay Powell's not going to budge. We'll see. Another big factor that the markets, even in these probabilities, aren't really factoring in is QT. Now, the Fed can supply the market with liquidity. It can increase the money supply. It can print more money. And that's what causes inflation. Over the past 2.5 years, 1/3 of the total money supply in existence was created. So that's a huge bump in a relatively short period of time. That's why we got 9 or 10% inflation. And that's why inflation will be sticky. So the Fed has hiked rates in order to try to tame it down. It's also doing something else in the background that a lot of people aren't paying attention to, QT. QT is simply doing the opposite of what the Fed has done for the past 13 years. It's shrinking the money supply. It's shrinking M2, the main measure of money supply. shrinking it at the fastest rate since the 1930s. That ought to tell you something. This loss of liquidity, as we refer to it, this loss of money supply is going to have consequences in that money will be harder to obtain. Liquidity will be harder to obtain. This increases the competition for the outstanding amount of money. And money has a supply and demand function. The more people that want it, if supply remains fixed or decreases, the higher the price. Well, the price of money is the interest rate. So QT in and of itself is going to force interest rates to drag higher and stay there if Powell continues it. And since most people aren't paying attention to it, well, I'm pretty sure that he's going to keep it up. Now, there's some other big events over the past week that have occurred, or are announcements or releases, I guess I could say better. For example, the New York Fed released their Empire Manufacturing Index, which is a good proxy for the amount of manufactured goods being produced in this country. Last month, or the previous month, it was down 23 points. This release showed it down another 16. That's pretty, sorry, getting my indexes confused here. This month's release showed it down 31 points. Again, the biggest drop since the 1930s, excluding the 2-week COVID lockdown when, we locked down to flatten the curve, if y'all remember that. The report also interestingly showed capital expenditures at near zero. It was 0.9%. So companies are not buying any equipment to increase production, to replace equipment that's wearing out. They're not investing in new plants. This is a significant result. Can you say recession? Now, some people, Elon Musk and some others, think we are already in a recession. But these kind of results point to we've only just begun. It's going to get worse. I do think once the bureau that declares an official recession sometime in the future starts looking back, they very well may say the recession begins now, or this past month or two. Trends are not good. The results, the information continues. The bad results, the bad information continues. For example, the Philly Federal Reserve Branch produces a non-manufacturing index. After being down 21 points last month, well, it dropped 16 points this month. The diffusion index, which the Philly Fed produces, is simply a survey of companies asking them whether they see increased business activity or decreased business activity. The diffusion index, as they refer to it, is just taking the number of companies that see increased minus the number of companies that see decreased. So it's a relatively straightforward index. Are you growing or are you shrinking? It's been shrinking significantly for 4 or 5 months, significantly these last 2 months. But wait, there's even more out there. A lot of people, at least earlier in the week, right now doesn't seem to be a problem, but earlier in the week, people were talking about how if we default on the debt, the U.S. will go into a recession. Well, we're already going into a recession. This may make it worse or not, but the idea is this recession is not going to be a weak one. The banking crisis, as Treasury Secretary, our much beloved, highly respected Treasury Secretary Yellen reminded us earlier this week, the banking crisis is not over. We can expect more banks to fail. Shocker, I know. But she mentioned what nobody else is saying. The banks are struggling with runs on their deposits. We've seen 3 huge failures so far. A lot of banks are on the edge and will ultimately end up being pushed over. Real estate, commercial real estate are huge threats to banks. And very reflective of what's going on in the economy. I just saw a survey the other day that said San Francisco office space had fallen 72% in value. That's amazing. That's worse than the subprime crisis. In addition, a lot of people, you don't see much press or attention toward the zombie companies. These are companies with a huge amount of debt that are basically have had interest payments equal to their operating profit or slightly less than their operating profit. Well, those interest expenses, particularly on the short-term debt as they refinance, are going to be at much higher rates. So those interest expenses are increasing. These zombie companies are at real risk. Nobody's saying anything. Nobody's paying attention to that. Banks are not lending. Obviously, with higher rates, there's lower demand, but also banks are tightening lending standards. It's tougher to get a loan, even if you would have qualified easily previously. Personal income's taking a hit. There's just a number of factors at work here to hurt the banking business. Now, the U.S. debt, it could default, it could not. But one big key, also something else that people haven't been paying attention to or talking about, is the U.S. has pretty much blown through its piggy bank, its cash reserves, its savings. Well, once the debt limit is resolved, Yellen is going to have to replace those funds in the kitty bank. So in addition to the normal borrowing that would continue on due to the budget deficit, she's also going to have to borrow hundreds of billions, trillion, 2 trillion in short-term treasuries to replace the funds in the reserve pile. That's going to add even further pressure to the short end, increasing rates even further. Also, keep in mind, U.S. interest expense is soaring as the Treasury debt that was issued in the past matures and has to be refinanced, plus the additional debt that is being issued. Right now, we're blowing through money at the rate of about $2 trillion a year, increasing the debt $2 trillion a year. A few years ago, it was only $500 billion, but the debt has just soared. Tax revenues, collections were down. So throw all this together, we're going to have huge funding issues with the Treasury in terms of issuing new debt. Now, we have seen some concerns in the market, obviously, this week. Even the FANG stocks talked about how FANG, Facebook, Amazon, Apple, Netflix, Google were leading the market, how those 5, 6, 7 stocks were responsible for over 50% of the market's movement since the beginning of the year, the increase. Well, even that index was down so far this week. It was down from 6,850 to about 6,700. Not a huge drop, but pretty significant considering its track record for the year. This is after being up 56% on the year. So bottom line, how likely is there to be a drop or collapse in the stock prices, in the bond prices, in the real estate prices? Pretty likely. That's my call. I'm sticking to it. And keep in mind, as with all collapses, when they do start, it won't take long. So, my advice to investors is don't panic, but rule number 1, don't panic. Rule number 2, panic early. Make sure you're the first one to panic. Those 2 rules still hold. You don't want to get antsy or nervous or make rash decisions. But when you see things consistently getting overpriced, stupid valuations, market ignoring huge significant events that are occurring, then you might want to panic. So don't be emotional, be thoughtful, be rational, keep your powder dry. You will very, very likely have greater opportunity in the future, 6 months, over the next year, to buy stocks a whole lot cheaper than you can buy them now. That's the brief update as we laugh at the ridiculous market. Join us Saturday night for Financial Failures. We'll be taking a look at the Bernie Madoff scandal and be joined by Mr. Ian Runkle of Runkle and the Bailey. So we look forward to seeing you, and thank you for your time.